Your Excellencies, distinguished guests, ladies and gentlemen, good morning and welcome to the 2025 Bank of Korea International Conference. My name is So-young Park from the International Relations team at the Bank of Korea, and I'll be your MC for the two-day conference. It is an honor to host this conference attended by prestigious delegates representing their countries or organizations. This year's conference marks a very special milestone, the 20th anniversary of the Bank of Korea International Conference. First launched in 2005, it has grown into a respected global forum for policy dialogue and academic exchange. Over the past 2 decades, this conference has brought together prominent scholars and policymakers from around the world, providing a unique platform to share insights and engage in meaningful discussions on the most pressing global economic challenges. This year's conference is held under the theme of structural shifts in monetary policy. Over the next 2 days, we will explore a wide range of subtopics, including inflation targeting, demographics, debt, climate change, and the AI and digital innovation. On the final day, we've also prepared a panel discussion that will bring together insights from across the conference theme. So please look forward to engaging and thought-provoking session. At this time, I would like to take a moment to express our sincere appreciation to Professor Thomas Sargent, whose insight and dedication have been central to shaping this year's conference. Professor Sargent, the William R. Berkeley Professor of Economics and Business at New York University, and a Nobel laureate in economic sciences, has served as a key organizer of this conference since 2007, offering invaluable guidance and leadership. We are deeply grateful for his continued contributions. Please join me in thanking Professor Sargent for his outstanding efforts. Thank you. So now let us begin the 2025 Bank of Korea International Conference. Before the main session begins, we will have a keynote speech. It is my great privilege and joy to introduce the Honorable Governor Christopher Waller, member of the Board of Governors of the Federal Reserve System. Before we invite him to the stage, I would like to give a brief introduction about him. Governor Waller is a distinguished member of the Board of Governors of the Federal Reserve System, where he has served since December 2020. Before his appointment to the board, Governor Waller was Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis. He has also held prominent academic positions, including the Gilbert F. Schaefer Chair of Economics at the University of Notre Dame, and the Carol Martin Gatton Chair of Macroeconomics and Monetary Economics at the University of Kentucky. He holds a PhD in economics from Washington State University and has contributed extensively to research in monetary policy and macroeconomics throughout his career. So, without further ado, please welcome him with a big round of applause.
Good morning. Well, thank you to the conference organizers for inviting me to speak today. I've attended this conference several times, and I'm honored to be on the program this year. Today, I will speak about the U.S. economic outlook and the implications for monetary policy. I will focus my comments on 2 key issues of interest. First, the effects of tariffs on inflation persistence, And second, the divergence of household inflation expectations and financial market measures of inflation expectations. The theme of this conference is structural shifts in monetary policy. The key structural shift that is affecting the economies of both the United States and South Korea is the recent change in U.S. trade policy. And a substantial share of my remarks will address how this shift is affecting the U.S. outlook. The variability in tariff announcements this year, including the whipsawing of court rulings and doubling of metal tariffs last week, has created considerable uncertainty about where trade policy will settle. In mid-April, based on how things looked at the time, I proposed two scenarios to consider in framing an outlook and a preferred stance of monetary policy: a large tariff scenario and a smaller tariff scenario. In both cases, I assumed that the tariff increases would lead to a one-time boost to prices that would temporarily raise inflation, after which inflation would return to its underlying trend rate. This temporary increase could play out with a prompt rise in inflation that could recede quickly, or it could occur more gradually with a more modest increase that would then recede over time more slowly. As I will explain, crucial to this judgment is my assumption that longer-term inflation expectations remain anchored. The large tariff scenario I described assumed an average trade-weighted tariff for goods imports of 25%, which is close to where things stood after the 90-day tariff suspensions announced on April 9th. And my scenario assumed that this would remain in place for some time. In that case, I argue that inflation, based on the Personal Consumption Expenditures, or PCE price index, could reach a peak of 5% on an annualized basis this year if businesses pass through all of the tariff costs to consumers. Now, if firms absorb some of the tariff increase, then inflation might peak around 4%. I also argued that an economic slowdown from these higher costs could push the unemployment rate up from 4.2% to 5% next year. Now, the smaller tariff scenario assumed a 10% average tariff on goods imports would remain in place, but the higher country and sector-specific tariffs would be negotiated down over time. In this case, inflation may rise to 3% on an annualized basis and then dissipate. Growth in output and employment would slow, with the unemployment rate rising, but not nearly as high as 5%. Now, reported progress on trade negotiations since that speech leaves my base case somewhere in between these two scenarios. The temporary reduction in China tariffs has significantly decreased the trade-weighted average tariff, since China supplied about 13% of U.S. goods imports in 2024. But that reduction is only temporary and is due to increase if a trade agreement is not reached by August 12th. Meanwhile, tariffs on other countries were temporarily lowered to 10%, but it is unclear where they will end up. Furthermore, the administration continues to say that it plans additional tariffs on specific industries and sectors of the economy. Now, last week's court decisions declaring a large share of tariffs illegal introduced additional uncertainty. But there seem to be multiple options for maintaining the tariffs, so I will stick with an estimated trade-weighted tariff right now of 15% on U.S. goods imports, which falls somewhere in between my large and smaller tariff scenarios. I see the risk of my large tariff scenario having gone down quite a bit, but there is still considerable uncertainty about the ultimate levels and what the impact it will be on the economic outlook. The context for this uncertainty about tariffs is that hard data on the fundamentals of the economy lately has been mostly positive and supportive of the Federal Open Market Committee, or FOMC's, economic objectives. There's little evidence of the effect of trade policy in this data on inflation or economic activity through April. But that may change in the coming weeks. Now, in comparison, there is evidence of tariff effects in the soft data based on surveys of consumers, businesses, and investors, indications of an expected slowdown in economic activity and an increase in prices. As of today, I see downside risk to economic activity and employment and upside risk to inflation in the second half of 2025. But how these risks evolve is strongly tied to how trade policy evolves. Now, a careful examination of the hard data on overall economic activity through April shows it has been, on balance, positive. I say this because while gross domestic output contracted slightly in the first quarter, private domestic final demand, a measure of spending by consumers and businesses, grew at a healthy rate of 2.5% in the first quarter of this year. Now, of course, economic policy uncertainty among businesses is very elevated, and this has affected measures of sentiment and confidence for consumers and businesses, which fell to historically low levels in April. One index of this policy uncertainty compiled from newspaper stories, government reports, and the dispersion of forecasts of private sector economists rose in April to nearly twice the level seen during the pandemic and the global financial crisis. Now, however, consumer sentiment rebounded with the announcement that the China tariffs had been lowered temporarily, and household spending should continue to be supported by income from the resilient labor market. In addition, my business contacts have told me that because of tariff uncertainty, their investment plans are currently on hold, but they are not canceled. So we may see a slowdown in investment in the near term, but a jump back up later this year. Wherever things end up on a continuum between my large and smaller scenarios, I do expect tariffs will result in an increase in the unemployment rate that will, all else equal, probably linger. Higher tariffs will reduce spending, and businesses will respond in part by reducing production and payrolls. Now, we won't get the jobs report for May until this Friday, but the consensus expectation is that employers added 130,000 jobs and that the unemployment rate remains steady at 4.2%. We have seen a reduction in wage pressures over recent months, and the ratio of job vacancies to the number of unemployed people has moderated from as high as 2 a couple of years ago to close to 1 today, which was about where it was before the pandemic. With a balanced labor market, if aggregate demand slows noticeably, businesses will likely cut workers. But I believe job cuts would be modest if the smaller tariff scenario is realized. Most chief executives I have spoken to said they can maintain their current operations with an effective tariff of 10%, looking for efficiencies here and there, and they won't have to significantly reduce their workforces. Now let me turn to the outlook for inflation. Before the recent shift in U.S. trade policy, inflation had been making consistent but uneven progress over the past 2 years toward our 2% goal. While that progress seemed to stall at the beginning of 2025, it has resumed the past 2 months. The same pattern of higher readings at the start of the year, followed by lower readings the next couple of months, also occurred in 2024, and I expect that research will eventually reveal some residual seasonal effect or other factor that has affected at least some prices early in the year, which has happened the last few years. Now, total PCE inflation for April rose 0.1%, and core PCE inflation without energy and food prices increased by the same amount. It was the second monthly reading at 0.1% or less. And it means that headline PCE inflation was up 2.1% over the 12 months through April, and core was up 2.5%. Our target is 2, so the latest readings, it's at 2.1. In the absence of the tariff increases, I was expecting inflation would continue to be coming down nicely to our 2% goal. But now I expect that the effect of higher tariffs will raise inflation in the coming months. The surge in imports to build up inventories ahead of the April 2nd announcement makes the timing of price increases somewhat uncertain. Thinking about the rest of 2025 and 2026, I expect the largest factor driving inflation obviously will be tariffs. As I said earlier, whatever the size of the tariffs, I expect the effects on inflation to be temporary and most apparent in the second half of 2025. This will be determined not only by the ultimate size of increase, but also how exporters and importers respond, something that is highly uncertain. Will foreign exporters discount prices to try and preserve market share? Will domestic importers absorb some of the tariff increases to shore up demand and sales volumes? Will firms simply pass the entire tariff along to consumers? Since about 10% of personal spending goes to imported goods, if the ultimate tariff levels are closer to my 10% number in the smaller tariff scenario, and if that is fully passed through to consumers, then the tariff would push up prices by 1%. But based on my conversations with business leaders, I suspect the tariff costs will not be fully passed through, and instead the burden will be distributed something like 1/3, 1/3, and 1/3 among consumers, importers, and exporters. In this case, it would raise inflation 0.3% for a very short period of time. However, if the tariffs are much higher than 10%, more of the increase is likely to be passed on to consumers as businesses face limits in how much they can absorb and still find a way to remain profitable. I have also heard from business contacts that firms may choose to spread the tariff across non-imported goods. This would increase many good prices a little instead of boosting import prices by a large amount. But contrary to some commentators, this approach would not affect the total impact of tariffs on the overall price level. So let me illustrate by using an example. I'm a college professor at heart. I have to use these kind of examples. So imagine a firm selling 10 goods with equal sales revenue so that they all have an equal weight of 1/10 when aggregating the firm's average price. Now assume one of the goods is imported. A 10% tariff on the imported good that is fully passed through raises the price of the imported good by 10%, while the prices of the other 9 goods remain unchanged. This pricing strategy raises the average price of all goods by 1%. Now suppose instead the firm chooses a different strategy and decides to spread the tariff across all goods by raising all 10 good prices by 1%. As a result, the price of the imported good increases much less, but the prices of the other 9 goods now increase a bit, even though they are not subject to tariffs at all. Now, under this strategy, the average price of the firm's goods still goes up 1%, and the tariff is fully passed through. So both pricing strategies have the same total effect on the aggregate price level across the firm, and if repeated, across the economy. The same logic applies to passing along the tariff via a sequence of smaller price increases instead of at a single point in time. In the end, the aggregate price level goes up by the same amount, regardless of whether it is gradual or immediate. I have heard the concern that some firms may raise prices opportunistically while blaming the tariff increase. There's always a risk that firms blame some purported cost spike for a price increase, but it doesn't happen often because of the risk of losing market share to competitors or squandering the allegiance of loyal customers. So while this may happen in isolated instances, I do not believe it will be a significant source of additional inflation above and beyond the tariff-induced increase. Now let me turn to the first of 2 issues about inflation that I want to cover in more detail. This is inflation and persistence. The economics behind a tariff increase implies that it should have a transitory effect on prices. Tariffs raise prices once, but then those prices don't keep going up. Now, I know that hearing transitory will certainly remind many people of the consensus on the FOMC in 2021 that the pandemic increases to inflation would be transitory. And inflation turned out to be much more persistent than we thought it would be. So am I playing with fire by taking this position again? Sure looks like it. So why do I believe a tariff-induced inflation spike will not be persistent this time? Looking back to how inflation played out in 2021 and 2022, I believe there were three key factors that increased the persistence of the initial burst of inflation in 2021. First, there was a negative labor supply shock that was more persistent than I expected. I believe that once the economy reopened, all of this labor would return to work. However, many workers left the labor market because of illness, or to care for children and family members who were sick, or they just simply took early retirement to avoid being exposed to the virus. They never returned. And with every wave of COVID-19, the United States experienced additional waves of early retirement that inhibited the labor supply from returning to its pre-pandemic level. Also, with the service sector shut down, demand for goods on spending exploded while that for services halted. And a negative labor supply shock led to a shortage of workers in goods production, delivery, and sales. Goods industries had to raise wages to attract workers, and then once the economy began to reopen, service sector firms had to pay these higher wages to get workers back. The persistent shortage of labor from these several pandemic-related effects continued through 21 and 22 into 23 as job vacancies skyrocketed and firms had no choice to pass along escalating wage increases in the form of higher prices. The second factor driving inflation after the pandemic was that the supply chain disruptions that many expected to be temporary, again, turned out to be more persistent. There were multiple waves of COVID affecting different regions of the world at different times, so that resolving production and transportation problems was constantly disrupted by the ebbing and flowing of the disease. One notable detail is that China's lockdowns lasted much longer than expected, and that played an important role in global supply disruptions. And the last factor was the quite stimulative fiscal response in the United States. There were hundreds of billions of dollars in grants to businesses to pay idle workers and large transfer payments to households. Furthermore, additional fiscal spending bills in 21 and 22 further stimulated aggregate demand. I'm willing to admit that at the time I underappreciated how the large and sustained fiscal response would combine with highly accommodative monetary policy to overstimulate aggregate demand in an economy that quickly recovered from the early effects of the pandemic. Let's turn back to today. I don't see factors like the three I've described here reinforcing the inflationary effects of higher tariffs. There is no longer a shortage of labor. And at least so far, no indication that tariffs are causing big disruptions in supply chains, as the recent surge in imports that I mentioned should attest. While Congress is putting together a tax bill, as it stands now, a large share of that legislation simply extends tax cuts that have been on the books for 8 years, and these would not be stimulative. Finally, monetary policy is in a very different position. We have shrunk our balance sheet by over $2 trillion, and our policy rate is north of 4% instead of being at the effective lower bound. So I do not believe one can use 21 and 2022 as a basis for predicting what will happen to the persistence of inflation arising from tariffs. Now let's discuss the second issue of diverging inflation expectations. I have argued that I believe the tariff-induced inflation will be transitory, and we policymakers should look through it when setting policy, as long as longer-term inflation expectations are anchored. However, right now in the US, we are seeing a dramatic disparity between household measures of inflation expectations and market-based measures, as well as the inflation expectations of professional forecasters. The University of Michigan surveys of consumers show that both near and longer-term inflation expectations have increased strikingly on net in the past few months and currently stand at 6.6% and 4.2% respectively. Meanwhile, inflation expectation measures based on prices of nominal versus inflation-adjusted securities have not increased very much, with two-year Treasury inflation-protected securities compensation around 2.7%, not 6.6, and 5-year and 10-year around 2.4, not 4.2. Also, the median from the survey of professional forecasters for consumer price inflation 6 to 10 years ahead is 2.2%. This highly unusual discrepancy between inflation expectation measures creates problems for policymakers. Whose expectations should we be paying attention to? Now, I personally prefer to look at market-based measures of inflation compensation and professional forecasters' expectations because they all have money on the line. Those buying inflation-protected securities lose money if they're wrong. Professional forecasters have clients and firms making financial decisions based on those forecasts, and they will lose customers if their predictions are wrong. As I used to teach my students, in a capitalist system, competition will drive firms out of business if they make bad decisions. Forecasting mistakes can be costly for consumers, but households aren't competing with each other, and they can't be driven out of business if they make bad decisions. But for the sake of argument, let's assume that the household measures of high inflation expectations are correct and financial market participants' expectations are too low. What are the implications of this mismatch? If households actually believe inflation will be nearly 7% for several years, workers would be expected to demand at least a 7% raise to keep their real wages from falling. If firms grant those wage demands, then inflation would rise by roughly 7% as the wage increases are passed through. Also, job search and the quits rate should increase as workers start looking for higher paying jobs. Is this happening? Although that was the story a few years ago in a tight labor market, I am not hearing about such an upturn in wage demands from my business contacts. And I don't see it in wage and compensation data. After several years of outsized pay increases and in a labor market that has loosened significantly from a year or two ago, I think workers don't have much leverage in asking for higher raises and are probably more worried now about keeping their jobs. Furthermore, instead of increasing, the quits rate is below its pre-pandemic level. So given labor market condition, it seems hard to believe that the high inflation expectations we are seeing in consumer surveys will lead to large nominal wage increases and a second-round burst of inflation. Now, a second point here is that if consumers believed we were about to face high inflation, they would be front-loading purchases, so much as importers seem to be doing, front-loading their inventories. But on the contrary, with the exception of motor vehicles, we haven't seen a broad surge in consumer spending, which overall is growing more slowly than it actually did in the second half of 2024. Now, for financial businesses, they set interest rates on their loans and financial products based on expected inflation. Their views should be embedded in market-based inflation expectations and those of professional forecasters. If they get the forecast wrong and the nominal interest rates on their loans are too low, then their real returns will be dramatically reduced and their profit margins badly squeezed. I have a very hard time believing interest rates are mispriced so badly. If they were, then households would think the real interest rate on loans is greatly suppressed. Consequently, loan demand for interest-sensitive products like houses, cars, and durable goods should surge. While loan demand appears to be healthy, there are no reports from banks or other financial firms that loan demand is surging. So based on wage demands, spending patterns, and loan demand, I see no evidence of economic activity that conforms to the inflation views reflected in the University of Michigan household measures, which, like other polling about the economy in recent years, may reflect attitudes about other factors than just inflation. So in conclusion, given my belief that tariff-induced inflation will not be persistent and that inflation expectations are anchored, I support looking through any tariff effects on near-term inflation when setting the policy rate. Fortunately, the strong labor market and progress on inflation through April gives me additional time to see how trade negotiations play out and the economy evolves. Assuming that the effective tariff rate settles close to my lower tariff scenario, that underlying inflation continues to make progress to our 2% goal, and that the labor market remains solid, I would be supporting what I called good news rate cuts later this year. Thank you very much.
Thank you very much, Governor Waller, for your insightful speech. Once again, please give him a big round of applause. Now, the policy dialogue between Governor Waller and Governor Chang Rhee of the Bank of Korea will begin. Well, now, Governor Rhee, you have the floor.
Yeah. Thank you, Governor Waller. It was an excellent speech, and as U.S. economy is so important, understanding U.S. economic dynamism is very important for us for our monetary policy decision. Before I ask you a question about your speech, if I just give my quick response from a non-U.S. country's perspective, I think that you mentioned your tariffs, baseline tariff and country level, but reciprocal tariff. But for us, sectoral tariff is as important as the other two, especially since we are exporting a lot of semiconductors, steel and aluminum now is increased 50%,
Right.
and the cars. So for us, unlike U.S., actually the sectoral tariff and what's going to happen after July 9th is kind of one of the key issues here. And my second point is that we are concerned very much about how our bilateral negotiation about our bilateral tariff will go ahead. But on the other hand, when we actually measure the impact of our U.S. tariff on us, the indirect impacts through China, China is very important because we are very much connected with them through supply chains. So not only our negotiation with the U.S., but also how the negotiation between U.S. and China will go is also important for Asian economy in general. And then also when we talk about our businessmen, I concur your statement that the 10% tariff, if it happens that way, the many businessmen here is also say it can be manageable. So that's kind of my short comments on your speech. But I'm most interested in your remark, and I actually watched some of your views that the impact of tariff on U.S. inflation can be transitory, and you explained many reasons why that can happen. But I also heard that some of your colleagues at the Fed have a different opinions. Since I now heard your logics very clearly, so it looks like quite reasonable. But what is the logic of your colleagues who has a different view that this tariff can last longer, except the expectation channel?
Yeah, I mean, one thing is it's good that you have different views and we're not all subject to groupthink, which we often are accused of, that we all have exactly the same views. So why do we need 19 members of the FOMC? You only need one if you all have the same views. So we do have different views. Part of, I would say, one of the general concerns that we have is, although the economic logic tells you a tariff is a one-time price level effect, much like an exchange rate shock or an oil price shock, it doesn't typically cause persistent inflation. that there are these kind of second round effects that pop up. The typical second round effect is some sort of wage pressure that pops up, that prices went up, consumers' real wages went down, they want a higher nominal wage to make up for it, and then that continues to get passed on. This discussion has been happening since the 1970s. So this has long been the case, and that's where this idea of like, you got to look through these one-time price effects as long as you don't see any wage pressures. Now, one of the things that has people, I don't want to speak for my colleagues in any way, but I think what often has people spooked is we had the same view in 2021 that all this stuff was transitory. It was a one-time level effect, and then it would all go away. And that just turned out to be wrong. And that was part of what I was trying to address in the speech, was about the persistence is what surprised us all. But when I think back, like what was it that caused all the persistence, as I said in the speech, none of that is in place today. So I simply am trying to understand the mechanisms that people have in their head, like why a one-time tariff effect would cause all this. I mean, suppose in the US that instead of a tariff, the president imposed a 1% sales tax on the US economy. It would have the same effect as a 10%.
Yeah.
We wouldn't be talking about this. We wouldn't be saying, oh, there's going to be wage pressures as people try to recoup a 1% sales tax. So some of this is just the discussion with tariffs is very different than it would be if you talked about any other kind of taxes, like a labor income tax or any other type of tax that we never talk about as being a big inflationary impact. So I think it's just the fact that we made a mistake before. People are nervous about making a mistake again. I get that completely. So, but when at the end of the day, I just sit down and think through the economics of this as policymakers have for decades. I just don't see the factors that are going to drive the persistence. It may be there, but I'm not seeing it.
Yeah.
There may be some other channels I haven't seen.
For us, the main reason why we are interested in knowing that the logic behind the temporary versus permanent inflation impact is basically we are thinking the U.S. monetary policy decision, which depends on the trade-off between the inflation and the output gaps. But if turn out that the impact on inflation is more transitory, but still, given that the U.S. inflation level is higher now than your target, and it will definitely slow down the inflation, the convergence to the target. In that case, you mentioned that the U.S. Fed will look through the inflation impact and then still may be able to cut the rate. But are you not concerned that the current level of inflation is higher than the average? And then if there is even the temporary impact for the next 6 months, if it goes higher, then are you still believe that the U.S. Fed has to cut the rate, given this trade-off?
Yeah, so first let me say, I speak for myself, not for anybody else. So it's not what the Fed should do, it's like what I think we should do. Let's make very clear about this. So I mean, for me, if you believe this is a one-time increase in the price level, and like I said, I prefer to look at market-based measures of inflation expectations, then if those expectations are anchored and it's a one-time price effect, then policy should really be looking at the real side of the economy if inflation is fairly close to your target. We are close to your target. I just gave you the number. Yeah. For the last 12 months, headline PCE, which is our goal, is at 2.1%.
Okay.
2.1. Yeah. It's not dramatically higher. Core is a little higher, but our target is not core, it's headline. Yeah. So we are close. It's not that we're far away. Okay. So I don't think even if you pushed a 1% temporary 10% tariff all the way through, you get up to 3%, and then it goes back down very quickly. If there's real damage to the economy, in my view, then at that point we should be focusing on the real side of the economy. Now, if inflation turns out to be a lot more persistent, then of course that makes the trade-off a lot harder, which is what I think you hear from a lot of my other colleagues. They think it's going to be more persistent, and so we're facing a very difficult trade-off. But for me, as long as I think this happens the way I've thought it would be, I don't think the trade-off is that hard.
Okay. And I'm also very much interested in knowing your remark on the difference between household measures and the market measures of expectation. we have a similar problem in the sense that the two measures are not going always together. But we have a slight difference is that we find that our inflation expectation measures based on household survey react very sensitively to the specific items in the consumption basket, such as food and others. On the other hand, unlike US, our market measure is kind of hard to use it directly because our market is quite shallow. So whenever there's some business size comes in, our market measures prices moves quite a lot because of the liquidity, impact rather than the expectation. And another question, maybe this is outside of the U.S. Fed mandatory, but recently we are very much look at the volatility in U.S. Treasury yield, especially longer side. Even with the expectation of the further interest rate cut, U.S. Long-term yield remain elevated. So I just wonder whether what you can explain what drives this new volatility these days.
Yeah, I mean, basically, I've always taken the view that we control sort of the short end of the yield curve, and then the markets determine the longer end. And what those factors are a lot of different things. I think more recently, what we're seeing is I attributed a lot of the rise to two factors. One is concern about fiscal sustainability in the U.S., that we've been running $2 trillion deficits for the last couple of years. That's 6% of nominal GDP. You just can't kind of run deficits that large persistently. I think there was some thought that the current bill would be a little more fiscally responsible in the sense of shrinking that deficit, but now all the estimates I've seen is it's going to continue at $2 trillion or more going forward. And the markets didn't think that was going to happen. So if there's going to be a lot more debt issuance than the markets thought, they'll buy it, but at a much lower price and a much higher yield. So it's not like there's going to be a problem selling it. It's just the price isn't going to be as high as it used to be. So that's factor one. Second factor is just given the tariffs and some other communications that have come out of the White House and the administration, there seems to be attitude that foreign buyers of assets are not welcome in some sense. So there's been a risk-off attitude from foreign buyers of treasuries, all U.S. assets, not just treasuries. It's not really that big, but it's definitely there. I'm hearing it every time I talk to sovereign wealth funds or I talk to large institutional investors. They're like, maybe we're overexposed to U.S. assets. Maybe we should be moving. And if that happens, the demand for all these things goes down, prices fall, and the yields go up. So I think those are the two main factors driving the 10-year right now.
Regarding your second point, we also trying to look at whether we can get some evidence whether there is any significant portfolio shift. But we haven't seen any change in the flow itself. But definitely, I think many portfolio managers and asset managers are talking about it. Yeah. So it's more like a sentiment and price impact without having any real flows. Right. Okay, and one more question about the Fed, recent Fed ongoing 2025 framework review. Since we are also thinking about to introduce some of communication tools with the public at the Bank of Korea, we are very much interested in knowing what will be the result of the 2025 framework review by the Fed. So can you elaborate on the key objectives and areas of focus in this coming review?
Yeah, so we just had our framework review conference 2 weeks ago. I believe it was 2 weeks ago. And in his opening comments, Chair Powell kind of laid out what were going to be the basic kind of changes to the framework. One is the flexible average inflation targeting, which we adopted in 2020. Didn't really work out quite the way we thought it would be. We thought we would allow kind of an overshoot of inflation for a period of time to kind of bring up inflation expectations, which are running below 2%. They were not anchored at 2%. So a lot of it was the strategy was you'd have to run inflation above target for a while. And as that happened, inflation expectation would slowly rise back up to 2%. The world changed. We got hit with a pandemic and inflation exploded. And like I said, a lot of things caused the inflations. So it really was really relevant for what we were trying to do. So, and it was not an easy concept necessarily for people to understand. You're averaging over what time period, how long. So if you're imprecise, then people really don't understand what the framework's doing. So that was one change. We're going to probably just go back to flexible inflation targeting. We're not going to try to say we'll run it high, or run it high for a period or run it low for a period of time. Just try to get it to 2%. The other major thing is this issue about shortfalls in labor market. We had a phrase about, we used to talk about deviations of unemployment from kind of trend. And the idea there was somehow if unemployment was too low, it was going to signal through some Phillips curve relationship that inflation was going to be higher down the road. I've never been a big believer in Phillips curves as any kind of structural, stable in fact, it's probably the most unstable relationship I've ever seen in my 45 years in this profession. So to build our framework on a Phillips curve kind of idea isn't really appealing to me, but everybody else seems to want to go that route. So there's probably take out the word shortfalls, replace it with something like deviations or something along those lines. The other thing we did was we had this phrase, broad and inclusive labor market, which tended to signal that we were targeting particular groups in the labor market to improve their unemployment rates. I don't think that was really what anybody was intending, but that's often how it was interpreted. So we're going to just go back to our job is maximum employment. We're not going to think about distributional consequences. We really don't have the tools for that, so don't try to go down that route.
Okay. More specifically, is this review have some section about whether you're going to how you evaluate your dot plot as a major communication tools?
Well, there's some discussion about our communications. I personally don't think we could change the SEP without our framework. I don't like tying the SEP up with the framework myself. I'd prefer to do it in a separate thing. But I mean, there's a lot of things that can be done with the SEP that lead to better communication. Some people have said just get rid of it. I don't think we can. I think that would be viewed as you're hiding something now. Right. You don't want to tell us something. But there's a lot of things. I mean, a simple thing is we do this calendar year forecast, 25, 26, 27. It should be just a rolling 6 months, 12 month, 18 month, and not pin it down to some calendar date. Just keep updating as you go forward. One of the other things that Chair Bernanke, former Chair Bernanke, talked about at our conference was moving more towards scenario analysis with saying, look, if these are the conditions, this is what we would do. If these are the conditions, this is what we would do. I could easily, this is just me thinking off the top of my head that I've thought about for a while, but you could easily ask people, here's a scenario, what does your SEP look like? Here's a different scenario, what does your SEP look like? So it just gives you two different SEP paths to communicate some uncertainty and differences, how conditions would change and how would you change policy. I don't think that's that hard, but and it could provide some additional information if you wanted to do it.
Okay, thank you. If you do not mind my personal opinion, I really like dot plus because that will give you more information of how individual members actually have think about the current situation. So definitely scenario analysis will help, but that can be in addition or some new additional information as you mentioned. So I hope that you can maintain the dot plus. It's my personal opinion. Yeah. Okay. And now, given that the title of this conference, main focus of the conference is structural shift and monetary policy. So if I switch this topic a little bit, now the AI is now coming everywhere, and the Bank of Korea is also trying hard to keep the pace with the market. And luckily, we have several domestic companies who actually develop a lot of AI-related models, large language models based on our own currency. Right. So we do a lot of private-public collaboration too. So I just wonder how much the Fed is actually investing and how the Fed is using the AI tools at this moment.
Yeah, so we're actively exploring how to use AI in a kind of a safe sandbox environment, so people can't do crazy stuff and somehow it gets out. So we do that, and we're not using any confidential data of any kind. We're just using kind of standard like speeches and things like that to see how it can be used and what you can do with it. We do have a few smaller AI projects that are actually in production around the reserve banks in the system, and we're looking at doing more of them. It has great potential to really improve like back office things, mundane labor issues. The debate, one of the interesting things I've heard recently is there's all this attention on the large language models, all the energy that needs to be provided to run them. But if you think about a lot of business applications, they don't need a large language model, right? A large language model will answer questions like how do you diagnose cancer versus what, literature essays or reviews. Why do you need that much computing power if you're trying to figure out how to answer phone calls a lot more efficiently? So one of the things I've heard from some of the industry is that smaller and medium-sized language models are more likely to be what are needed for businesses to be more productive. They don't need the full large language models. So you might see a lot more competition in that space, and those things are a lot cheaper to run, both in energy and everything. Fractional cost compared to what it would cost to run the large language models. So we're still in this world of trying to figure out exactly what to do with them and how they're going to improve productivity, and do we need the large language or can we do a smaller version of them? But I personally think it's going to be phenomenal. I use it all the time to kind of practice speeches. I kind of run my old speeches, tell it to give me a speech. I haven't used one yet, but my speechwriter doesn't want to lose his job, so.
Same problem. I'm using a lot of my English translation using the AIs. And actually, one of your remarks is music to us, because you mentioned that the future trend will use more small-scale AI models. Yeah. In that case, that will benefit Korea economy very well, because we have chip makers who are quite good at producing HBM and large-scale server-type models. But if the AI can be used for the mobile phone and the small scale, yeah, that will definitely increase the chip demand. And then, as of now, I think in the world there are not many alternatives than Korean companies. So we hope that they can, introduce that kind of small-scale technology will be more widely used to alleviate my problem of the lost 6 months that our country had. So, okay. Another thing is structure shift is digitalization of the economy, and I know that you are in charge of the Committee on Payment Settlement at the Fed, and I also watch your Atlanta Council, dialogue and talk about the navigating the future payment system. So, in regard that, can you just explain what is the U.S. government stance on the stablecoin regulation? And I know that the new registration will come very soon.
Yeah. Well, I can't speak for the
Yeah.
U.S. government on stablecoin legislation. But the concept of stablecoins, it's just, for me, it's just a payment instrument that could potentially be provided by a non-bank entity. Historically, banks did a lot of things. They extended credit, and they did the payment system for most countries. But there's no reason somebody can't come in and be a payment instrument, much like a bank deposit. Somebody else could issue some other object that gets used as a payment instrument. So that's what I personally find a stablecoin is a new way to introduce competition in the payments industry. Instead of just having the banks handling all the payment, let private sector come in and compete. Payment fees are actually relatively high in the US. We hear this all the time. Now, you had mentioned earlier, and I know other countries, they just regulate the prices to be low on payments. Different philosophies. I don't like being told I have to set the price for things in general. So I'd rather see just competition. Global payments, very expensive, particularly for small and medium-sized firms that have to do international payment transfers. So I just view it as a nice way to introduce more competition and drive down costs from the private sector instead of the government or regulator stepping in and making these decisions. Now, I don't think banks like it too much, but as far as I'm concerned, make sure the playing field is level so that banks can issue it if they want. There's going to be more regulation on a bank simply because they do credit extension and everything else. Whereas if you had a very narrow payment provider, all they do is payments, collect fees, they don't extend credit, they don't do anything. And so why would you not want to have a narrower, less intrusive set of regulations on a pure payment provider as opposed to what you would have to do if a bank was involved?
Yeah, actually, the regulating the fees is one aspect, but actually this issue become quite controversial issue, and in Korea these days, I explained in the morning, whether we have to allow the issuance of the Korean won-denominated stablecoin to the bank or just non-banks too, and that has quite a lot of dimensions for us to think about financial stability. But more importantly, unlike US, we have a capital control. So before we make sure to allow the non-bank financial institution to do this business, we have to think about whether there is any chance for these tools can be used to bypass our capital controls. So either we can reduce our capital controls, but but that has quite a different policy discussions. But I think we ought to be more cautious than the United States because of the capital control, and many other Asian countries also have a very similar concern. So, by the way, as for reducing my final question, given the time constraint, is I actually learn a lot from your Atlanta Council, talk, because both U.S. and Korea is a member of the Agora project.
Yep.
To reduce the fees for the international transactions, and after U.S. has a policy stance to not going for the CBDC, especially retail CBDC, and we are concerned that whether the momentum of the Agora project can be changed. But can you repeat what you have talked? Because that will be good information for our audience. What is your stance on the Agora project?
Yeah, so just the first comment, I'm not a fan of central bank digital currencies. I gave a speech in August of 21, which basically said they were a solution in search of a problem. They don't really add anything to the current payment structure of the U.S. Maybe for other countries, but not for the U.S. I didn't see any value in it. And that speech pretty much slowed down this train that was going around the world that everybody had to have a CBDC. And pretty much now, other than the ECB, I don't really hear a lot of any of the central banks that are going to continue on with it. So I know we're pretty much dead and buried with it. Now on Agora, if people are trying to think about how to lower cost of payments, particularly global payments, right now the payment system is you have to go through the correspondent banking system. So I want to make a payment from my small bank in Indiana. It has to go to a large bank in the US, and it has to go to some correspondent they have in another country, who eventually gets it to some small bank in Germany. At every step, they have to do KYC, money laundering, everything, over and over and over, and everybody takes a cut in that process. So as I understand it, I'm not going to speak as an expert, but the Agora project that the New York Fed and the BIS and other central banks are working on is, could you think of a simple platform where all the kind of banks can somehow connect into it, and you get rid of this chain of payments so that there's one payment that somehow all the banks get connected through it. You're not getting rid of banks, you're not introducing a new payment, it's a technology that better connects banks, much like if you were an Uber, and now I can connect and pick up a cab anywhere or whatever. It's just a better way to match everybody in a quicker and more efficient way. We're working on it now. By the end of the year, we should have, the hope is to see some kind of prototype working model. We have the design ideas done, but we're looking at seeing how the prototype could actually work. And if that works, you're just making the correspondent banking system much more efficient. And that should lower cost as well. And time. Every time you do these steps, it takes time to do all this stuff.
I fully agree that the goal of the Agora project should be to reduce the cost of international transaction and by digitalizing our financial system. So,
yeah, just a last comment on this. A large part of this slowness of global payments and the cost is we put frictions into the payment system. We want to do money laundering. We want to do illicit terrorist finance. We want to do all this checking. That's regulatory. That's not the, I mean, a bank could make a payment like that if they didn't have to do all this stuff. So that's kind of one of the problems. A lot of these frictions are by design. I'm not criticizing, I'm just saying they are by design. And we still want to have those, but it doesn't mean we have to do it at every step of the correspondent banking chain. We just do it once, finished, it's over. And that's one thing I know with global stablecoins, that is what they do, because they can have direct payments. They don't have to go through this chain.
Okay. I think given constraint, I'm so pity that we have to finish.
Constraints? What a concept in economics.
Yes. But anyway, so I don't want to monopolize this dialogue. I'm very sorry that I cannot offer you to have questions, but we'll have a half an hour coffee break, so you can ask questions directly to Governor Waller. And we'll have 1.5 days conference. And thank you very much for your insight, and look forward to having more discussion.
Thank you, Governor Rhee.
Thank you.
Thank you all.